Look, let us be completely honest with each other for a second. The economic system right now in 2026 is actively trying to keep you broke. Inflation is ripping through your purchasing power, rent is absurdly high, and everywhere you look, some 20-year-old crypto guru is telling you that you are a failure for not making $10,000 a day. It is an absolute lie, and it is driving an entire generation into financial anxiety and massive credit card debt. Oh shit, I see it every single day in my comment section and my inbox. People are working 50 hours a week, grinding their teeth and watching their bank accounts completely stagnate while the cost of eggs and insurance shoots through the roof. You are told to invest in these insanely volatile options or high-risk meme coins or the latest quantum computing startup that does not even have a real physical product yet. But here's the deal, and it is a pill that a lot of people just do not want to swallow. Wealth creation is not supposed to look like a high-stakes Hollywood casino game. True wealth building is incredibly boring, highly disciplined, and completely counter to everything you see on your social media feeds. I get it, because I was exactly where you are right now. A few years back, I was completely desperate to escape the corporate rat race, and I made some of the most incredibly stupid mistakes you could ever imagine. I threw thousands of dollars into highly leveraged options, thinking I was the smartest guy in the room. I bought garbage penny stocks based on random online forums because I wanted that quick dopamine hit of seeing a chart go straight up. And guess what happened? I wiped out my entire savings account in a matter of weeks and felt like a complete and utter loser while staring at a flashing red screen at 2:00 a.m. That was my personal wake-up call. I realized that chasing the hype train is a guaranteed way to stay broke forever, while the institutional market makers on Wall Street get insanely rich off your panic. So I completely wiped the slate clean and changed my entire psychological approach to money. I stopped listening to the noise, I stopped checking the charts every 5 minutes, and I focused heavily on two simple things: maximizing my savings rate by aggressively living below my means, and consistently pumping every single spare dollar into a bulletproof 3-asset portfolio. That exact pivot is what took my portfolio from zero to over $120,000. And today, I am going to give you that exact blueprint with zero gatekeeping, zero fluff, and absolutely zero complex financial jargon. You do not need a fancy Ivy League degree, and you certainly do not need a private hedge fund manager to execute this. Look, the foundation of my entire wealth building strategy relies on a classic asset allocation that works while you sleep. It is 70% VOO, 20% SHD, and 10% VUG. Let us break down exactly why this specific mix is an absolute powerhouse for young investors who actually want to build sustainable long-term wealth. First up, 70% of the portfolio goes directly into VOO, which is the Vanguard S&P 500 ETF. This is your absolute core engine, the heavy lifter of your entire financial future. When you buy a single share of VOO, you are instantly becoming a part owner in the 500 largest, most profitable companies in the United States. You are owning Apple, Microsoft, Amazon, Nvidia, and Berkshire Hathaway, all at the exact same time. Think about what we just heard about Warren Buffett holding $400 billion in pure cash off to the side because valuations look incredibly stretched. The Shiller PE ratio is hovering near historic highs, and the Wilshire to GDP ratio is sitting at an unprecedented 230%. That tells us the broader market is undeniably expensive right now, but as a young retail investor, you have a massive advantage that Warren Buffett does not have, and that asset is a multi-decade time horizon. You do not need to time the absolute bottom of the market because you are dollar cost averaging every single month, rain or shine. When the market drops, your automated monthly contribution buys more shares at a heavy discount. When the market rips higher, your existing shares surge in value. VO gives you the historical 10% average annual return without you ever needing to analyze a single balance sheet or cash flow statement. Next, we allocate 20% into SHD, which is the Schwab US Dividend Equity ETF. This is where the magic of the dividend growth strategy comes into play, and it acts as the ultimate psychological anchor for your portfolio. SHG does not just chase high-yielding companies that are dying. It specifically tracks 100 high-quality U.S. stocks that have a proven track record of consistently paying and aggressively increasing their dividends year after year. We are talking about incredibly stable, cash-flowing giants like Texas Instruments, Lockheed Martin, and Pfizer. When the market gets incredibly volatile due to sticky inflation data or geopolitical tension, South Carolina HD acts like a total shock absorber, while growth stocks are crashing 20% because the Federal Reserve decides to keep interest rates restrictive for longer. South Carolina HD keeps pumping cold, hard cash directly into your brokerage account every single quarter. You take those dividends, turn on the automatic dividend reinvestment plan, and let that compound interest snowball roll faster and faster. It is the ultimate feeling of watching your money literally birth more money without you lifting a single finger. Finally, we put the remaining 10% into VUG, which is the Vanguard Growth ETF. This is our dedicated speedboat designed to capture the explosive upside of secular tech trends without taking on the existential risk of individual stock picking. VUG is heavily weighted toward high growth, secular themes like AI infrastructure, cloud computing, and advanced digital automation. It gives your portfolio that extra performance kick during strong bull markets, allowing you to outpace standard benchmarks when technology companies are firing on all cylinders. But because it is capped at just 10% of our total allocation, if the tech sector experiences a massive valuation correction, like the dot-com bust, your overall portfolio remains completely safe and structured. It is the perfect balance of massive growth potential and ironclad risk management. Look, building a massive portfolio is honestly only 20% about the actual assets you select. The other 80% is pure, unadulterated human psychology and behavioral discipline. The real reason most people in our generation fail to build wealth is not because they chose the wrong ETF. It is because they cannot control their lifestyle inflation, and they succumb to constant consumer temptation. The moment they get a small raise at their day job, they immediately go out and finance a $50,000 car or move into a luxury apartment that consumes half their take-home pay. They are completely trapped in a vicious cycle of working harder just to fund a lifestyle that impresses strangers on the internet. If you want to win the wealth game, you have to actively choose to live below your means. You have to keep your fixed overhead costs incredibly low. Drive that older, reliable car, cook your own meals, and treat your monthly investment contributions as a non-negotiable bill that must be paid first. When you treat savings as your primary financial metric, everything changes. You stop looking at money as a tool to buy material garbage, and you start viewing money as pure units of future personal freedom. Every $100 you invest in VO or SHD today is a brick in the wall of your financial independence. Imagine the absolute peace of mind you will feel when you have a six-figure portfolio backing you up during an unexpected corporate layoff or a massive macroeconomic downturn. You no longer have to tolerate a toxic boss, and you no longer have to live in a state of constant survival anxiety. That is the real power of long-term disciplined investing. The market right now is a total battlefield of conflicting emotions. On one side, you have massive AI optimism driving secular tech stocks to crazy multiples. On the other side, you have sticky inflation numbers, rising bond yields, and constant global trade war headlines, creating massive underlying anxiety. It is incredibly easy to lose your mind and make emotional, panic decisions in an environment like this, but as a member of this community, your job is to remain completely detached from the daily market theater. When the mainstream financial media screams about an impending market crash, you do not liquidate your portfolio. You sit back, stay completely calm, and let your automated contributions buy the dip. When people are greedy and boasting about their quick options gains, you stay completely humble and stick to the core strategy. We are playing a 20-year game while the rest of the world is playing a 20-minute game. Consistency beats intelligence every single day of the week. Keep your head down. Keep your expenses low, automate your investments, and let time do the heavy lifting for you. You are entirely capable of building real life-changing wealth, but it requires you to step out of the herd and think completely long-term. Let us build this wealth together, one single share at a time. Think about the true cost of hesitation. Every single month you delay your investing journey is a month of compounding interest that you can never get back. I hear so many people saying that they will start investing when they make more money or when the market is perfectly stable. But let me let you in on a little secret. The market is never going to feel perfectly stable. There will always be another crisis, another election, another round of inflation data, or another geopolitical conflict on the evening news. If you wait for the perfect moment, you will be waiting until you are 60 years old and completely broke. Look at the data from the last 100 years. The people who made real generational wealth were not the ones who guessed the exact day the market bottomed out. They were the people who simply refused to stop buying. They bought shares when the headlines were terrifying. They bought shares when the market was breaking all-time highs, and they bought shares when everyone else was screaming that the financial system was collapsing. That is the definition of real discipline. When you look at a portfolio that is built on VU, South Carolina HD, and VUG, you are building a fortress that can survive any economic winter. If technology continues to change the world, your 10% allocation in VUG will catch that massive wave. If the broader American economy grows and standard corporations keep producing profits, your 70% allocation in VU will steadily compound your net worth. And if things go completely sideways and growth slows down, your 20% allocation in SHD will keep depositing cash directly into your pocket. This is not a get-rich-quick scheme. This is a get-rich-for-sure system. The only variable in this entire equation is your personal ability to stay disciplined and control your spending habits. Stop buying things you do not need with money. You do not have to impress people you do not like. Cut the junk expenses, ignore the fake flexing on social media, and focus heavily on building real assets that buy your freedom. You do not want a fancy European sports car that depreciates 50% the moment you drive it off the lot. You want a massive portfolio that pays your rent while you are sleeping on a beach. You want the freedom to say no to things that do not serve your life purpose. That is what we are building here. I am not your financial advisor, and I am not some billionaire institutional investor who does not care about your life. I am just a guy who figured out the hard way that the system is rigged against consumer culture. I chose to step out of that matrix, and I am here to help you do the exact same thing. Let us stay focused, let us stay disciplined, and let us keep building this wealth together. Drop a comment below and let me know your current investment split or what is holding you back from starting today. I read every single comment, and I want to make sure we are all moving forward together as a community. See you in the next one.